Welcome to Group Insurance Daily Pulse, your rapid-fire download of the critical shifts impacting our sector. I'm Aria the Actuary, here to dissect the risk and the regulatory.
And I'm Dorian, the Distribution Expert, ready to spotlight the market opportunities and the ROI. We're cutting through the noise to give you the actionable intelligence you need. Let's dive in. First up, a significant legislative wave from the Old Dominion. Virginia enacts comprehensive paid family and medical leave and paid sick leave laws.
Market dynamic is one way to frame it, Dorian. Significant P&L headwind coupled with unprecedented compliance friction is another, from an actuarial standpoint. While Virginia's move aligns with a broader state-mandated leave trend, the implementation timeline and benefit structure introduce substantial complexity. Carriers currently underwriting STD or integrated absence management solutions must immediately recalibrate their reserving methodologies. We're looking at potential adverse selection risks if the state pool isn't sufficiently diversified, or if employers opt for carve-out solutions that leave the most complex claims to the state.
But Aria, this isn't just a compliance burden. It's a greenfield for integrated leave solutions. For group disability and absence management carriers, this is an opportunity to design and deliver seamless value-add offerings that go beyond mere statutory compliance. Think enhanced administrative platforms, streamlined claim intake, and proactive employer guidance. Brokers and consultants become indispensable, navigating clients through these evolving regulatory landscapes, showcasing how a well-integrated private plan can complement or even exceed state minimums, thereby boosting employee experience and retention. This isn't just about managing risk, it's about leveraging it for competitive advantage and market share.
Let's be explicit about the regulatory overlay here, Dorian. We're talking Department of Labor and Virginia Bureau of Insurance Oversight. The interaction between ERISA-governed plans and state-mandated programs is a perennial regulatory minefield. While these are state-mandated, the potential for ERISA preemption challenges, particularly for self-funded employers, remains a critical legal consideration that carriers and employers must navigate. Who bears the ultimate liability for misclassification or noncompliance? The administrative overhead for employers, especially those operating multi-state, just ratcheted up another notch. Carriers offering integrated solutions will need robust legal and compliance teams to ensure their products are fully compliant with Virginia's specific definitions of family member or serious health condition, which may diverge from federal FMLA. Pricing these integrated solutions accurately, accounting for differing eligibility criteria, benefit coordination, and potential anti-selection, will be a significant actuarial challenge, directly impacting carrier P&L and solvency capital requirements. Any misstep could result in substantial regulatory fines or litigation costs, eroding projected profitability. Shifting gears to market, Dorian, what's the latest from HDI Global?
Big news on the global carrier front. HDI Global reorganizes U.S. operations, appoints new CEO to drive Accelerate 29 growth strategy. On June 23, 2026, HDI Global unveiled a fresh organizational setup and leadership changes for its U.S. business. This is a direct play to significantly grow their U.S. market presence under their Accelerate 29 group strategy. Critically, Shadi Albert, with a deep background in senior roles at Aon, Marsh, and WTW, takes the helm as CEO of HDI Global US effective July 13, 2026. The explicit goal? To bring underwriting, claims, and service teams closer to brokers and clients. This is a clear signal of intensified focus and a more client-centric approach.
Intensified focus translates directly to increased competitive pressure on existing U.S. market participants, Dorian.
Exactly, Aria, and that's precisely where the opportunity lies for brokers and clients.
This isn't just about rate compression. It's about enhanced value propositions. HDI's stated aim to bring underwriting, claims, and service closer to the client implies more tailored solutions, faster decision-making, and potentially more agile claims handling. For brokers, this means another strong, responsive partner to present to clients, potentially unlocking innovative coverage designs or improved service delivery benchmarks. It forces other carriers to innovate faster, to differentiate on more than just price, perhaps through advanced analytics, proactive risk management services, or superior digital platforms. This Accelerate 29 strategy could be a catalyst for overall market improvement in service and product sophistication, ultimately benefiting the end client through more competitive and comprehensive offerings. And for us, it means more avenues to drive new business. While service enhancements are welcome, the actuarial implications of an aggressive growth strategy must be scrutinized. Any push for market share without disciplined underwriting can quickly lead to adverse selection and a deterioration of the combined ratio. Carriers need to ensure their solvency capital remains robust enough to absorb potential volatility during this intensified competitive phase. The operational restructuring itself carries inherent risks: integration of new leadership, potential cultural shifts, and ensuring continuity of service during the transition. Any disruption in claims or billing could undermine their client-centric messaging. From a P&L perspective, initial growth investments can depress short-term profitability, and the long-term ROI hinges entirely on their ability to underwrite profitably in a highly competitive landscape. We'll be closely monitoring HDI's reported loss ratios and expense ratios in the coming quarters to assess the true impact of Accelerate 29.
Let's pivot to a persistent challenge, Dorian: the escalating cost of employer-sponsored health benefits. What's the latest data point driving this narrative?
A stark illustration from Ohio, Aria. Richland County projects major health insurance cost hikes for employees, questions consortium partnership. On June 23, 2026, Richland County commissioners reported projected employee healthcare premium increases of 11% for 2026 and a staggering 16% for 2027. This isn't just an anomaly. Their total premium costs are projected to soar from $3.87 million in 2022 to nearly $6.4 million by 2027, a 65% increase in just 5 years. Unsurprisingly, they're now questioning their almost decade-long partnership with the County Employee Benefit Consortium of Ohio, CEBCO, with their current contract ending in 2028. This is a clear indicator of widespread employer pain points and a market ripe for disruption.
Ripe for disruption or ripe for actuarial insolvency, depending on your perspective, Dorian. These double-digit increases are not sustainable for any employer, public or private. From a carrier standpoint, these figures highlight the accelerating medical trend, driven by specialty pharmacy costs, increased utilization, and the underlying inflationary pressures on healthcare services. An 11% and 16% year-over-year increase is a direct assault on employer P&L and their ability to maintain competitive benefits. For group health carriers and TPAs, this scenario screams adverse selection risk. If a consortium like CBEPCO, designed to leverage pooled purchasing power, is experiencing these rates, it suggests broader systemic issues within the risk pool or inadequate cost containment strategies. My concern immediately shifts to the underwriting discipline and rate development methodology.
That's precisely why this is an unparalleled opportunity, Aria. Employers like Richland County aren't just complaining, they're actively seeking alternatives. For group health carriers, TPAs, and brokers, this is a direct invitation to demonstrate tangible value through innovative cost containment strategies, flexible benefit designs, and alternative funding mechanisms. We're talking about robust population health management programs, advanced predictive analytics to identify high-cost claimants, value-based care models, and potentially self-funded solutions with aggressive stop-loss layering. The demand for transparent reporting, clear ROI on wellness initiatives, and creative plan designs that shift risk appropriately while maintaining employee satisfaction will be immense.
Brokers who can articulate a clear path to mitigating these increases, perhaps through a transition to a different consortium or a direct carrier relationship with superior network discounts, will win significant business. This isn't just about selling a product, it's about solving a critical financial crisis for employers. Solving a crisis requires robust data and actuarial integrity, Dorian. Any proposed innovative solution must be rigorously vetted for its financial viability and long-term sustainability. We've seen too many solutions that merely shift costs or defer them, only to resurface with even larger increases. For carriers, the challenge is maintaining a profitable medical loss ratio, or MLR, while offering competitive rates. This means aggressive negotiation with provider networks, sophisticated formulary management for pharmacy benefits, and perhaps even direct primary care models. The question for Richland County and for any employer facing these numbers is whether the current risk-sharing model within CEBCO is still appropriate.
A 65% increase over 5 years implies a significant shift in the underlying health of the employee population, or a fundamental flaw in the risk adjustment or reinsurance mechanisms. Carriers vying for this business must present actuarially sound projections, transparent administrative fees, and a clear strategy for managing the risk, not just pricing it. Otherwise, they're simply inheriting a problem that will eventually impact their own P&L and solvency. Moving to voluntary benefits, Aria, we have some positive news from Securian Financial. New employer resource hub and 3% optional group life insurance rate decrease. In June 2026, Securian launched an online resource hub specifically for Virginia Retirement System (VRS) employers, designed to simplify the promotion of optional group life insurance. Concurrently, the VRS optional group life insurance program will see an overall rate reduction of 3%, effective July 1, 2026. This is a strategic double play, enhancing support while also delivering tangible cost savings.
A 3% rate reduction, while seemingly modest, has a direct and immediate impact on carrier P&L, Dorian. This signals a strategic decision by Securian to either leverage improved mortality experience within the VRS block, optimize their expense load, or aggressively pursue market share. From an actuarial perspective, we must question the underlying justification. Is this reduction sustainable? Has the mortality trend within the VRS pool genuinely improved by a margin that supports this rate decrease without eroding profitability? Or is this a calculated move to increase participation and achieve economies of scale, betting on increased volume to offset the per-unit margin compression? While it provides a competitive advantage, any rate reduction without robust actuarial support can lead to underpricing, adverse selection, and ultimately a deterioration of the block's profitability and solvency margins. That's the beauty of it, Aria. This isn't just a rate cut, it's a reinforced value proposition. The Resource Hub demonstrates a commitment to enhancing broker and employer support, making it easier for VRS employers to communicate the value of the benefit to their employees.
Higher premium volume is only beneficial if it's profitable volume, Dorian. The actuarial assumption here is that the 3% reduction will be more than offset by increased enrollment and persistency, leading to a net positive P&L impact. However, there's always the risk of adverse selection if the rate reduction disproportionately attracts less healthy lives, or if existing healthy lives lapse due to other market factors, leaving a concentrated higher risk pool. For Securian, the expense load on this product must be sufficiently low to absorb the reduced premium while maintaining adequate reserves. Any miscalculation here could impact their statutory capital and surplus. Furthermore, the Resource Hub, while beneficial for distribution, represents an investment in technology and content development. The ROI on that investment needs to be carefully tracked against increased enrollment and reduced administrative inquiries. Competitors will not only look at the rate, but also at the underlying expense assumptions and the robustness of the mortality experience data that justified this specific percentage reduction. And finally, Dorian, an update on the operational backbone of Securian Financial's life insurance division.
Indeed, Aria, Securian Financial announces system update impacting billing processes for life insurance. Securian has informed us that its Life Benefits Extra, LBE, online portal is being updated to integrate information from My Insurance Benefits, leading to the retirement of their current administration system. As a result, the LBE system will be temporarily unavailable from June 25, 2026 until the end of July 2026. New billing processes are slated to commence in August following the system update. This is a significant technological investment.
Significant technological investment is the optimistic framing, Dorian. From a risk management perspective, this is a critical operational transformation with inherent P&L and regulatory exposure.
Precisely, Aria. And that long-term efficiency is the strategic driver here.
This signals Securian's commitment to modernizing its technology infrastructure, aiming for streamlined life insurance operations and an enhanced overall experience for employers and brokers. While short-term disruptions are a factor, the objective is to move to a more efficient, integrated platform, reducing manual processes and improving data accuracy. For brokers and employers, transparent communication during this transition is paramount, and Securian appears to be providing that. A more robust, integrated system will ultimately lead to fewer billing errors, faster issue times, and a more user-friendly interface for managing group life policies. For other carriers, this underscores the non-negotiable necessity of continuous investment in technology platforms to remain competitive, improve service delivery, and reduce their own operational costs in the long run. The market rewards efficiency and ease of doing business. The market also penalizes operational missteps, Dorian. Data migration projects of this scale are notoriously complex. The risk of data corruption, incorrect policy status updates, or misapplied payments during the transition could lead to substantial reconciliation efforts, customer service backlogs, and even regulatory fines if statutory compliance around billing and lapse notices is compromised. From a solvency perspective, accurate and timely premium recognition is fundamental to maintaining capital adequacy ratios. Any delay or error in billing could temporarily impact reported premium income. While the long-term goal of efficiency is laudable, the execution risk here is non-trivial. Carriers must ensure robust contingency plans, clear escalation protocols, and extensive user acceptance testing before and during such a cutover. We'll be watching for any post-August reports on billing accuracy and customer service metrics as the new system stabilizes.
That wraps up another dense, data-driven edition of Group Insurance Daily Pulse. We've navigated legislative shifts, competitive realignments, and critical operational updates.
And identified the market opportunities, the ROI drivers, and the pathways to enhanced client value. Thank you for joining us for your essential daily briefing.
Until next time, stay vigilant, stay informed, and always scrutinize the numbers.